Alrighty, traders. This is Blake, and you are listening to the Face Show. Good morning, happy Thursday, and holy moly! Um, well, I guess we should start with a quick conversation before Luke Groman gets here about Davos. I mean, Ryan, taking a step back and seeing everything that transpired over the last 24 hours. What are your thoughts other than you'd like to have some hot salsa with that taco? What are you thinking right now?
Oh, I love the taco analogy because it's absolutely completely wrong. Um, yeah, well played, Mr. Trump. He's done it again. He's done it again. He's pushed and fought and insulted and got Europe running around in a panic, threatening trade wars, whatever. And he's ended up, or likely to end up, with exactly what he wanted in the first place, which was a bigger presence in Greenland, NATO taking responsibility or increased responsibility as European countries. So, you know, it was a surprise that the market sort of got
Fell
so
for it?
about it. And, here we are again. He called it a taco. Some call it exactly a play from his book, The Art of the Deal. So yeah, here we are. We can put that to bed now for a while. Europe will still moan about it, no doubt, for a few weeks, but we're probably over that hump. What's next? Cuba, Cook, the tariffs case.
Yeah, and so you're right. I mean, here it's like right from the art of the deal. Everybody saw it coming, but the market still reacted to it, and so that begs the next question. You look at the S&P, and we basically there's actually a couple things I want to talk about here, and I'm gonna bring K-Man in to talk about this here in just a second. But look, you got the S&P. We gapped down right Sunday. Here we are about ready to fill the gap. I would assume we're going to fill the gap today. We talked about it last night. Like here's the gap fill is where we're going to be, closing in on. That was yesterday, last night, and here we are today. We are closing in on that level as we speak. It's not.
It took
It's not
two
very.
comments. It took two comments from Trump to get that.
Yeah, and so there you go. You got your self-inflicted wound. We're about ready to do that now. Now, here's the other thing, and this is the point I want to make here. You look at the euro, and the euro, different situation. We gapped down here. Let me just show you. We gapped down here on Sunday, and you fast forward to today, we are nowhere near that level. So what does that tell you? I mean, look, the S&P is almost recovered. Dollar, people are like, screw that. I'm not buying it. And then you just had ECB minutes that just came out, a little bit more dovish. They read a little bit more dovish than the ECB has been recently. So, I mean, what do you make of that, K-Man? And good morning. Wait. I'll do it. I'm going to do this, Ryan. Happy birthday to K-Man. Happy birthday to K-Man. Happy birthday to
Mr.
K-Man.
The wine drinker.
Happy birthday to you. Happy birthday, K-Man. Good morning.
Yeah, good morning, and thanks very much of reminding me I'm 1 year older again. What I make of the ECB, not a lot. Really not a lot. People say it's a little more dovish, but then we know that the opinions are a bit divided on inflation over there. You got the doves saying that it will continue to come down, and then you got a few hawks, we know who they are, the Germans, etc. Who think it's going to remain sticky. But as a result, the rates are pretty much cemented where they are right now, and we are waiting for fresh data. I do think that at equal inflation, it's all going to be growth that's going to determine what they are doing next. And perhaps, we are going to, going forward, I mean, maybe not in the immediate seeing any impacts, but going forward, if you look at what happened at Davos, the thaw, let's say, the more reconciliatory tone. It's going to bring, in the end, it's going to bring the data back to the forefront. So I think we are going to have to see what growth is doing in Europe to know where the euro is really going. I was looking at it this morning. It's absolutely depressing to see those euro dollar vols again. Volatility has come completely out of it again. So that is going to have to keep us on the quite low expectations side of things,
I
barring.
mean, we dropped a full percent since
Sorry?
2 days ago.
Yeah, absolutely. I mean, once we're over, it usually does that after an event, that vols are coming down because people are getting out of their options or doing the hedges, etc., and not putting on new stuff, which is keeping the vols high. But it's the levels we're at. If you're talking about the 1 month at the money under 5%, it's not really something that you are going to look at to put trendy trades on. But you can still trade the ranges. There's nothing wrong about that. So yeah, that about the ECB. I'm not reading an awful lot into it.
Okay, and that really wasn't my point. My point is,
Oh,
you got the S&P that basically has closed the gap, but the dollar's nowhere near that. You would think, okay, we got a situation. We all got trumped, if you will, and stocks have kind of recovered. But the dollar didn't. The dollar still remains weak, and that's the point I'm trying to make is why isn't the euro trading down at 115? Well, let's even call it easy where the gap was. Let's say we're back at 116. Why isn't the euro down at 116 where you have the S&P that's already almost done filling the gap? That's the point I'm trying to make. Do you have any thoughts on
I
that?
mean, you have the opposite effect of risk on and risk off. Yesterday we had a risk on, risk off move. Then you had a dollar move. But if you look at the bond market is hardly moving. So why would the dollar actually move a lot? The thing is, FX is only occasionally correlated these days to what the bond market is doing and what the equity market is doing. We had a move lower yesterday in the euro dollar back to 116.70 75, and we're just stuck in the middle. And you need more option volatility. You need more volatility in the market to really drive it around. What is interesting, though, I would say, and that also correlates to the euro dollar. Euro dollar is used as a transition instrument to do all the rest. If you look, for instance, the expression of risk, but yen is a bit of a different story. But all yen pairs are higher. You look at risk through the lens of the antipodians. The antipodians are better bit, okay, for various reasons, but they are both better bit. That is risk on. You look at the Scandis; they are better bit. You actually trade risk in a different ways, and the euro dollar is just a transit instrument to do everything. And
Yeah, yeah. So
that is the
it's
problem
real.
for euro dollar right now.
I find it really, really fascinating, just kind of where everything is settling, and that's the interesting thing. We got Luke joining us. I'm going to bring him in just 1 second. I'm really excited to have Luke here, so thank you, Luke, for being here. We're gonna kick it off in just a second, but I do want to point out also. You look at fixed income. We had a sell off, obviously, over the weekend, and you see, treasuries selling off, yields rallying. I'm gonna actually probe Luke about the Sell America trade. I was just listening to the Odd Lots podcast, on Bloomberg, and the head of PIMCO was just on there talking about it. And I'm going to talk about some pension funds, and we're gonna get in that discussion here in a second. Hopefully, both Ryan and K-Man brought some questions for Luke, because it's nice to have such a distinguished guest here. But I do want to point out that yields continue to rally, and they're holding the breakout point. Look at the 10-year. We are above the 200 DMA. I know none of us like to use technicals on yields so much, but if you look at the ZNs, which is the notes, you can see we are well below the 200 DMA. We're holding the breakdown point. We're still at the 38% retracement of, basically the 2025 previous range. But that's a little vulnerable to me. It gets a little scary if we start continuing this move lower. We see yields rip, and if the dollar doesn't respond, that's when I start to get really, really worried about the dollar. Ryan, before I continue on, and I want to bring in Luke, I do want to ask one last question. We saw the sterling get shook up a little bit. Can you just kind of tell us what had happened with the sterling? There was some political news surrounding the market, right?
Yeah, there was. Not that the Americans are going to be up on it, but there's an MP who has been caught out for dodgy messaging and whatever, has been suspended by the party. He's been given a take it or leave it, clear off deal. It opens a door for potential by-election, and the person who may step into that is someone called Andy Burnham, who's mayor of Manchester, and he's not a fan of the bond market. He's also not a fan of Starmer. And there's been an ongoing theme that he could at some point put in a leadership challenge. So this potentially, if all the ducks fall in a row, opens a pathway to that. But it was not a big move in the quid, but it was interesting how the market reacted to that news, because that's how we expected the market to react to that sort of news. And it gives us a bit of a basis for headlines moving forward.
Yeah, Euro sterling really shot up, and it was during the flow show. I was catching the tail end of the flow show, and I think K-Man, you were speaking, and all of a sudden the sterling got hit. And if you're watching the squawk, or you're listening to the squawk, you realize that had happened. All right, well, thank you for the update. We appreciate that. And I want to bring in right now Mr. Luke Groman, and good to see you, Luke. How are you? I'm glad you can make it here today.
Likewise, thanks for having me on. Sorry about the snafu yesterday. I apologize.
No problem. Hey, look, before we get into the markets, so there's something only a few people will appreciate, and you're one of them. I've listened to you for years. I first got turned on to you with from another trader who traded at Lehman. He was a trader that I traded with out of Greenwich. For a firm, and he's like, "Hey, have you ever heard of Luke?" And next thing you know, I'm listening to your stuff, and I've always listened to. I like to listen to as many of your videos and podcasts as possible. I'm a huge fan, but I know you are a huge fan of baseball. Is that correct?
I am, yes, sir.
well then, I'm proud to tell you this, and not, like I said, not a lot of people are going to appreciate this. Our next door neighbor and great friends of ours that we've known since our kids they grew up together since they were like 4. His son just got a full ride to Pepperdine. He's going to be a wave. A full ride scholarship. He was one of 9. He just went over to Malibu last weekend. Wow. He's a stud. Hopefully, you're going to see him on TV in the years ahead. So
that's awesome. Yeah, Pepperdine's big time. It's baseball. College baseball is a funny thing because there's like these little schools that are D1, and it's a baseball world. So yeah, if he's going to Pepperdine on a full ride, no less, like he can play because the money's hard to come
guaranteed.
Good
and
for
him. He's in his senior year. He signed actually just before his senior year started. So he's a stud.
Great.
He's
good for him.
Anyway, I knew you could appreciate that. So welcome to the show. There's been obviously a lot going on. I'm going to bring in K-Man and Ryan also to ask a couple questions here. But I want to get your initial thoughts on just the hurricane typhoon that we got in Davos over the last couple of days. What's your instant reaction and immediate take?
My instant reaction and immediate take of Davos is, and the last few weeks really, is that people who live in glass houses shouldn't throw stones, and nations that are dependent on foreign capital shouldn't walk around talking about how easy it is to take other people's stuff. Because the United States has a net international investment position of, $27 trillion. That means foreigners have $27 trillion more in dollar assets than we have there. And then you see this sell America trade. You see the Japan, there's a sell Japan trade that's been going on, right? Yen down, yields up, of sorts. And I agree 100% with your sentiment that you said before if yields keep rallying and the dollar doesn't, that's a problem. And everything that was said and done in Davos, everything that was said and done around Venezuela, everything that was said and done around Iran, but in particular, the commentary from the multiple members of the administration of essentially might makes right. We can take what we want if you can't defend it. There's $27 trillion sitting in the U.S. markets that can't be defended by foreigners. And we've already frozen Russian reserves 4 years ago. We all saw what that has done to various markets in terms of capital flows, but gold in particular. And so I think they need to be very careful. If I'm a foreigner and I've got trillions sitting in the U.S., if I've got billions sitting in the U.S., as of a couple weeks ago, I'm starting to move some of it out. I'm starting to hedge my risks.
All right. Well, that's that. So that brings up another point. I was listening to, I think I mentioned, I was listening to this Odd Lots podcast and listening to the head of PIMCO. His last name is Roman. He's a French gentleman.
It's Dan Iveson, right?
No, I thought it was, hold on, let me
Manny
see.
Roman.
That's
Manny
right. Manny
Roman.
Roman. Manny Roman.
Okay. Yeah. Okay.
Yeah, and he was talking about like the there was the Dutch, or I'm sorry, who was it, came in, that one of the pension funds, like we're exiting the US, and he's like, it's so small, it doesn't really matter. But I think that sentiment, in my opinion, is the wrong sentiment, because it's this trend that we're starting to see. It's like the analogy I use. We're all sitting in this movie theater, we're watching a movie, and you're like, you sniff it and you go, I think I smell some smoke. You look back and you see a couple, the door open and a couple people are running out the back, and you're like, the movie's still going. That's the way I see it. It's not like, oh my God, we're all rushing out, but at the same time, I smell smoke, or at least I think I smell smoke. What do you say about that, Luke?
Well, I think it's important to understand the context in which all of this is happening, because I agree with him. It is, in the grand scheme of things, the Norwegian or wherever it was, the Swedish, maybe whatever, it's small potatoes. I get it.
Right.
And the bigger picture is this Trump Fed fight is ultimately, in my opinion, a symptom of, look, for 25 years, we have done dumb things with borrowed money. We've gone to wars on false pretenses. We've bailed out things in non-capitalistic ways in terms of, we should have done away, the equity should have been wiped out. The bondholder should have taken the equity. Fraud should have gone to jail, et cetera, et cetera. We stayed with stimmies probably longer than we should have. So we've got this gigantic debt load. We've got this gigantic, as a size of percent of GDP historically in non-recessionary times, deficit to GDP. And so to me, the context in which that smoke is happening is critical. And what I mean by that is the Trump Fed fight is not where we are now as a result of the bad decisions on borrowed money for so long, is either one of two choices. Either the Fed is now in charge of U.S. domestic economic policy, foreign policy, and foreign economic policy, because our debt is so high. An independent Fed means they raise rates, and we have to cut spending on defense, entitlements, domestic programs to make room for the interest. Fed's in charge, unelected body. That's not how it works. The alternative is what Trump is pushing, which is we are a sovereign government, and we are in this debt position. And therefore, if we are a sovereign government, then the Fed must be subservient to us until we inflate this debt away enough such that we are no longer in this position, this fiscal dominance position. And I think that's ultimately where it's going to go. And in that context, like, he who panics first to the back of the theater panics best, because they're going to crush the real value of your bond. I mean, look, since 2020, in gold terms, the long bond's down 90%. Yeah. And I think it's going to, now it's okay, Luke, that's at extreme. Okay. Take it back to 2014, when global central banks stopped buying treasuries on net. Put TLT over GLD since 2014, right?
That's right here, by the way, if you guys can't see it, it's basically this time frame. So
right. So there, you're at what, 160 on the ZB there, and you're somewhere around there. 114 now. You're down what, 40%, 30%? 30% long bonds against gold in that, and that's just there. If you put it over gold, in that time, you're down 90%.
It's crazy, right? I know you're a huge in gold terms guy. You've been, obviously very, very bullish precious metals. It's been a great call. I've been listening to you obviously for years. But you made one other comment recently. Well, actually, I've heard it multiple times. You're not so bearish on equities, though.
No, I am. The thing that makes me nervous about equities, the only thing that will make equities go down, in my opinion, in the U.S. would be capital outflows, and sort of the sell America trade, and geopolitically, we're heading in that direction, which makes me a little bit, ultimately, I don't think any capital outflow trade leading to lower equities will be allowed to persist for very long. Either Trump will taco, as he may have just done yesterday, at least on some level, or they will backfill. The policymakers will backfill with printed money, one way or another. And then the release valve would be the dollar, and they'd have to do something with the yields, obviously, cap yields, whatever. And so that's why it's part of the reason why I like gold so much, and why I think it's important to look at everything in gold terms, because that's telling you what's really happened, right? You look at S&P over gold, we're below March of 2020 lows. And that's the real story. I think they are in terms of looking at it that way. But yeah, I'm not bearish equities. I'm not even that nominally bearish long bond anymore, really. Like, I think it could trade to 4.6 or 4.7, right? But that's like, I'm not a person who's like, hey, yields are going to go to 6 or 7. I think ultimately yields go to where they create problems. In my opinion, that's 4.6 to 4.8 on the 10-year. And then something is done to inject liquidity. Gold and equities react, wash, rinse, repeat. And the more we do this, the more equities rise only in dollars, but fall in gold terms.
Interesting. Okay. I have my colleagues here, Ryan and K-Man. Ryan, both of them are, the Flow Show hosts. K-Man's been trading on bank desks for 40 some odd years. Ryan, old trader on the live floor, FX guy, but traders extraordinaire. Gentlemen, do you have any questions for Luke? I know this is a kind of a special situation. Normally we host, but having Luke here on the F.A.C.E show, I figure you guys might have some questions.
I've got one, and okay, you can go first. Up to you.
No, go ahead, Ryan.
So obviously we're talking about this Sell America trade and everything. So my question to you is, because you've obviously spoken about this being a potential crisis in the treasury market and whatever previously, but is this another one of those situations, a bit like when people talk about the size of US debt, and if that goes pop, the bond markets go pop and the financial world collapses? Is this something that we're in that situation again, where the market's just seeking headlines or going for headlines rather than this is actually going to turn into something? Because you guys have come through, like the rest of us, global financial crisis, COVID, all the ups and downs over the last 20, 30 years, and that hasn't managed to destroy the treasury market. Is that something Trump can really do in 3 years? And secondary to that, if there is, we have all these little people, these little names, not being disrespectful, funds and whatever, saying they're exiting out of US and whatever. But if someone big said those comments and actually made those moves, they're going to create a panic in the bond market that's going to blow them up as much as it's going to blow everything else up. So there's no upside for anyone jumping out of US bonds because it's such a big market. It's the old too big to fail. So yeah, my question is can Trump cause this in the next 3 years? And is it really valid that anyone's going to really make a move out of the bond market?
I think that's why I'm so focused on the gold side of it. Gold is just simply, as Greenspan said in 2014, it's the one better currency than the dollar. And that's why I think it's so important to look at not just equities, but like if you look at the long bond divided by gold, since central banks stopped buying treasuries on net and started buying gold, it is a fascinating, and if you take that ZB and put divide it by gold on there, right? So ZB divided by gold
Let me see if I can do XAU, or I can just do it this way.
Or divide by, yeah,
There you go.
right? And if you do it back to 2014, right? So that's,
I mean, that is just a crazy, crazy move.
right.
384%.
Well, and if you divide it by it too, right? That because dividing by ZB divided by gold will give you the price of it in gold, right? So that'll give you the price of ZB priced in gold. And it's down, it's down 80, 90% since then. And so I don't think anything's going to blow up the treasury market in nominal terms. I agree 100%, too big to fail, et cetera, et cetera. It has blown up and I think it's going to go to zero against gold, basically. It's down 90%. It'll finish going to zero against gold. And what that will probably look like, in my opinion, is the 10-year will trade between 3.5 and 4.5 on a yield basis for the next 5 to 10 years. And gold will go to 10 or 15,000. And then once it gets there, you can kind of recap things. As far as big people selling, in my opinion, I would point to two things. China's already largely sold. So China came out at the end of 2013 and said it's no longer in our interest to grow holdings of treasury bonds. They said no longer in our interest to grow FX reserves, but we're done buying treasuries. They said that, announced it in November of 2013. And they've gone around and basically played our sentiment of, nothing could ever happen to treasuries against us. In other words, the Western lens is these are good collateral and these are always good to have. And the Chinese are like, oh, really? Okay. Well, you take the good collateral, we'll take the copper mine. You take the good collateral, we'll take and so they've been going around the world lending dollars for commodities. And by lending dollars against commodities around the Belt and Road, around Africa, around Europe, etc., they've been able to lay off their entire treasury portfolio on a net basis. They're gone. They've already sold all their treasuries for commodities, which is interesting because after the West seized Putin's FX reserves in 2022, in the summer of 2022, he gave a speech that said, these seizures are going to result in everybody stockpiling commodities instead of treasuries, instead of euro debt. And that's what they've done. You can, since he said that, gold's up 170%, silver's up 340%. So I see the data's coming up here. I'll be real quick. The trade here is getting out of debt and basically putting the debt back to the West, who can't afford a rate above a certain level. So I agree it's too big to fail. And where the release valve is showing up is the value of Western currencies against gold, silver, and commodities, which then feeds on itself because then inflation and expectations picks up, rate of pressure picks up, more money has to be printed to cap yield. So it's a tricky situation.
It really is. What? Go ahead, Ryan, if you want to follow up there.
No, I was just thanking Luke for his answer.
Yeah. All right. K-Man, we are just less than 60
you got the
seconds
numbers,
away
right?
from data. But do you have a question for Luke? Because we'll try to keep him on for a couple more minutes after the data before we bring on Arnaud.
Yeah.
But
You want to get the data out of the way first?
Yeah. We just so everybody knows, we have initial jobless claims coming out. We have also GDP price index. Let me just bring over the instant reaction kind of panel we have here. Initial jobless claims, obviously. So we have yields off to the right, the dollar right here in the middle, and then the S&P off to the left. So we're just going to see what instant reaction we get. Luke, thanks for hanging on with us through this data. Really appreciate it.
Of course.
Yeah. That GDP is the final number, so it shouldn't be a big deal unless there's
shouldn't be a huge mover, right?
Jobless claims, okay, 200K.
Final GDP higher?
Yeah, slightly.
Yeah, slightly higher.
4.4. 4.4 versus 4.3 consensus.
And initial claims.
Profits okay.
Yeah.
Everybody's making money.
What's interesting is we see yields go up. Dollar tried to go higher, and the euro's just not relenting. Either is the Aussie. The Aussie continues to hold its breakout. So Again, this is really interesting when you see yields go up and the dollar's just not really responding. And I'm not saying that it won't. It's just it's that topic we've been bringing. Hey, before we let Luke go, I know K-Man, you probably had a question for Luke, so let's go ahead and bring it.
Yeah, and interestingly, we had quite a big discussion about this very subject yesterday on the Face show, actually. So yeah, the too big to fail thing is one thing, but just in the numbers game, don't you think it's actually the U.S. market is too big of an anchor for any participant worth of the name in the market? And I'm not talking about $100 million Danish pension fund. I'm talking about governments. I'm talking about the huge asset manager community pension funds that other markets just cannot absorb the amounts of money that are turning around in the markets. We know about, by the way, I completely agree with you on the metals. But isn't the US market just deemed just to stay there just because of the sheer stability in a way I know in money terms it may be different, but in yield terms and versus inflation, is it just not too big a market for anyone to move out of it? And because if we talk about the Australian market, for instance, yes, I mean, somebody like PIMCO or BlackRock, they may put 4 or 5% in Australia, but you can't put 95% of your holdings divided by Australia, New Zealand, and Canada, or just to give an example. Don't you think that the US market is just there to remain as an anchor for all markets, and the other markets are just going to gravitate around at different speeds, but still going to gravitate around?
I think I agree that it is so big that I think most big market the whales are going to have a real hard time getting out of anything into other than gold, right? You look at the market cap increase in gold last year, 60%. Like that's 7 or 8, $9 trillion of market cap. You know, that's a big market. They can move into that, and they're not there. They're Westerners. Western pensions own basically zero gold, and so that'll be something interesting to watch in terms of, an acceleration out of that into those. I do think it's showing up. The other parts, I think you'll see reordering on the margin where, U.S. equity market cap's 2/3 of GDP or 2/3 of global equity market cap. Is it going to 10%? Probably not. Is it going to 30%? Probably not. Can it go from 65 to 50? Yeah, it could do that. And where's it going to show up? It's going to show up in, the euro going up against the dollar, despite horrible fundamentals in Europe, kind of no matter the US print, right? Like we just saw. I think we're watching it. It's going to show up in the yuan, strengthening. There was 150 billion in capital flowed into China in December alone. They said it was the highest number in 10 years. I would expect to see more of that. And, then you get into, okay, are there tipping points, et cetera? And ultimately, I think, again, the U.S. government can't afford more than 4.6 or 4.8 on the 10. So anything that leaves is going to get backfilled. And that's why I like the metals and in particular gold so much is pensions aren't there. It's the only thing big enough. And anytime this shifts drive the yields to levels for the U.S. government that are uneconomic, it's going to get backfilled with printed money, which is going to show up in gold, wash, rinse, repeat.
Can you imagine? I mean,
yields
go
up. I fully
up
agree on those metals, etc. And that you look at different markets. It's just that, as you rightly pointed out, it is the fact that those whales and wherever they may be from, Japan or the PIMCOs or the BlackRocks or whatever, they are going to shift from, as you say, as an example, from 65 to 50%, but they are not going to go down to 25, 30. The anchor market, well, in my opinion, at least, the anchor market is still going to be the US. But where I agree with you is that we may still have a lot further to go, because if you look at FX, for instance, even if your dollar moved 10 or 12% higher over the past year, it's no panic stations yet, right? Would you agree with that?
I would agree with that. I would say the one caveat to my point and the answer to your question is I think Japan is the first warning, right? If Japan has a lot here And if the JGB market dictates that they need to repatriate trillions back, then there's not, or the currency market dictates that, that is not going to be a market reaction. That's not going to be, hey, gosh, Japan is so much smaller than America, and so we can't get it out of America back here. That's going to be, wake up, sell everything you can, get it back here, have a good day. Next day, wake up, sell everything you can, get it back here, have a good day. And that will continue until either it spreads around the world or somebody caps Japanese yields again or what have you. And that to me is the caveat to that, where it could go fast in those scenarios, right? You guys know better than me. When the margin clerk comes, you don't get to say, well, I want to try to VWAP this order. It's get me my effing money now, right? And if that happens to Japan, that's a different story that none of us have ever seen, myself included.
Yeah. Wow. Luke, I have to say it's been wonderful having you here, and I'm gonna reach out and try to get you back here in the next few weeks and kind of see where you're at and see where the world's at, which I'm assuming the world is going to look a whole lot different 4 to 6 weeks from now than it does today. That I can almost guarantee.
Yeah, I apologize. Thanks for having me. I apologize, Arnaud, for cutting into your time. So I'll jump right away and let you guys get to it.
Appreciate you having you here, Luke. Thank you so much for joining us. And everybody, make sure you give Luke a big follow. And actually, you should be reading his the Forest Through the Trees. You should be reading his FTT. I always get the acronym wrong. Can you please say it, Luke, for me?
Yeah, FFTT, Forest for the Trees.
There we go. Thank you very much, Luke. Thank you so much for joining us. I'll be reaching back out to you, and have a great day and have a great remainder of your week.
Thanks. You guys too, guys. Thanks for having me on.
All right, traders. Hey, now we have, and thank you, K-Man, and thank you, Ryan, for your very, very insightful questions, gentlemen.
No worries, mate. Have a good interview.
All right. And now you guys are in for another treat. We got Arnaud from Intelligent Investing with us today. Arnaud, how are you? It's been a while since we've had a discussion.
Hey, Blake. Good morning. I'm doing great. How are you doing?
I'm doing great. My head's spinning a little bit from the last couple of days, so I'm sure yours is too. So let's just kind of jump into it. And sorry that bled over a little bit. We had kind of a scheduling mishap yesterday, so thank you for your patience. But I'm going to ask you the same question I asked Luke. What were your takeaways from Davos over the last 24 hours? I know it's been a bit of a whirlwind, but what's your immediate takeaway here?
I've wrote to my members pretty much. I'm not surprised. We all know how Trump deals. First, he throws you against the wall, and then hopefully, when you peel off it, you take the deal. That seems to be the case, right?
Right.
If you've read the book, the Art of Dealing, or what it's called, that's pretty much how I look at it. From a Greenland perspective, I didn't follow too much of the economics. Follow some dirt throwing between the White House and my governor Newsom. That was quite interesting as well. But that has nothing to do with the economics. I think the big deal, of course, here is Greenland and the tariffs and the usual Trump posing, where he first warns people, I'm going to throw on tariffs if you don't do what I do, and then he goes onto the negotiation table and takes them off or adjusts them. And I think that's exactly what we've seen again. So I'm not too surprised. I can't predict the future. He could have stuck with them, but now that it has gone through the pipeline, sure, that I think we saw that coming in that sense.
All right. Well, it seemed pretty logical, and the point I was trying to make a little bit earlier with having Luke here was we've seen the S&Ps almost, or actually before Luke got here, I was talking to Ryan and K-Man from our team. You got the S&P. We've almost closed the gap from Sunday, yet the dollar is not anywhere near the 116 level where it was on Sunday. So we're seeing, this is pretty much like, oh, okay, yeah, equities have responded, but the dollar not so much. So what are you making as far as market response to all of this?
Yeah, no, yesterday, of the day before yesterday, today's Thursday, Tuesday, right? I think that was a logical reaction, of course, to see a large drop. And in that sense, of course, it's now been baked into the markets. And then, you know, you got the counter reaction. It's a bit deja vu what we saw in March and April when you know, originally the tariffs were introduced. Then we saw this quite scary market drop. I kept hammering, by the way, to my on the table for my members, saying, "Oh, this is a bimbo," and a bimbo means that you should buy in every major bear market. It's every major bear market is a buying opportunity. So put that together, you get the word bimbo. And I think this case, the same as well from a pure technical perspective. On Tuesday, the markets got pretty oversold. And as a trader, when your system says it's been oversold, you have your technicals, then you just have to act. And that's what happened, and I think we're going to get the counter trend rally. And from an Elliott wave perspective, in my work, I still don't see the market as having completed its final advance yet before we go into I would say 2022 style market. So
why don't you show us what you're seeing then?
Sure.
I'd love to see it.
Yeah, sure. So I always say, you know, let's go back first. The last webcast I did was in October, and there I was looking for a pullback here in a green 4. So, you know, different waves of different labels. I color code them to differentiate them a little bit better than the standard with, parentheses around it. And then, of course, we have different numbers. We have Roman and we have numerical numbers. And so we have this green 4, which is a wave degree. We call it minor in this case. And I'm still looking for a wave 5 to this target zone here for a third wave where I think we're in a large ending diagonal that it's a little bit different than a standard impulse. But overall, wave 5 was still pending. This was in October. And I think we got there. So, right, this is October. We got the pullback for the wave 4, and we should now be in this wave 5. Now, the advance since then has been quite overlapping over the last 2 months. So, but this wave 5 is still ongoing. And yeah, it starts to look a little bit bleak on, this is a weekly chart, by the way. So every candle is 1 week. Starts to look a little bleak on the technical indicators. But we're now in that target zone between about 6,800 and 7,100, where this wave 3 can top. And then we should see a large pullback, in this case of about 1,000 points, before we see a final wave 5. And here I'm starting to at the 2020 low, the March, the COVID-19 crashes. So that was a very important low. And then we have a wave 1, a 2, and a 3, a 4, and a 5. And as you might know, markets move 99.9% of the time in 5 waves up and 3 waves down. And we haven't had 5 waves up. The problem here with the April 2025 low is that it overlapped here with the 2021 high. That's not allowed in a wave 1, 2, 3, 4, 5 standard setup, as you probably know. So we're still looking for a larger 4 pullback and then a wave 5. And we have a nice turn date coming up somewhere in April. I can talk a little bit about that in a bit. Now, if we then zoom in even more, we see those turn dates again. April turn dates, they're based on seasonality and Armstrong Pi turn dates. So seasonality, if you take 98 years of the S&P 500 and only look at midterm years, right? This year is a midterm year. So we're going to filter out the post-election year, the other years, only look at pre-election years, which means you only have 25 years left, and you take an average of that. It means we're kind of, meandering around with a slight upwards bias into April, and we should top at around April 18, ideally, right? Plus or minus, of course, maybe a week or two, somewhere around there. That's the average seasonality. Market doesn't have to follow it. There are many times the market doesn't follow it at all. But if we go a little bit closer to home, the market should have topped out somewhere January 16, 17, which I believe it did, and then bottom out somewhere around January 21, 22, maybe 26. So we're right around there again, right? Again, doesn't have to be exactly on the date. That would be too easy.
Right.
That'd be nice.
That would
It
be,
sometimes
that would be
happens,
nice.
but
It'd be nice.
yeah, it would be nice. It sometimes happens, but most of the time it doesn't. It's about the general path. That's the kind of general direction. So here we're looking for a top at around April 18, somewhere around there, mid to late April. If we then go to the Armstrong Pi cycle, this is by Marty Armstrong, we have a turn date coming up April 28. And this has been quite reliable in forecasting market tops. Not all the time, there are a few misses, but again, you see here 2025, it nailed the top exactly. A smaller top here in 24, massive top here in 21, 22. Missed a little bit the COVID crash, but it didn't take too long before it happened. Nailed here 2018, etc. It nails more tops than it misses. We have maybe 1 or 2 misses out of all these, I don't know, 20 tops or something since 2002. So it's pretty accurate. So, as long as it works, we have to assume it keeps on working. And that is at around April 28. These are just ratios of this pi number, which is about 3,146 days. And you take ratios of those, you half them or a quarter or an eighth. And then you can see the market listens to those quite well. So that brings us also to end of April. All right, so we have seasonality and now this one as well, which point towards end of April. How can we then match that with the price action? Well, as I showed, we can have a diagonal forming, a little bit sloppy towards that 7120 number, somewhere around there. So we're starting to get close, right? I think we topped somewhere around 6,900 last week or whatever it was. And that will work. If I then go, markets are fractal in nature, so they keep repeating the same pattern. Right? Not exactly, but it's mirror image, but a little bit of dust on it. And we see here in 2024 into 25 that we had a ending diagonal, and that one lasted for quite a while. And it seems like we're starting to follow a similar pattern. We don't have to. We know our price levels below which this analysis and analogy is wrong. And that's always the most important thing. With Elliott Wave, you can slap on a lot of different price patterns. That's often the problem because you're interpreting it to the best of your knowledge. And then you can have 2, 3, sometimes 4 different wave counts. And it's very confusing for people. Which one is it? Well, you have to go with the most likely one, but the best thing to do is use invalidation levels. That's what we're using, and I'm going to go over those in a minute. And as long as we stay above these invalidation levels, I have 5, meaning that every time we break below a certain level, it increases the odds that the uptrend is over by 20%. So at some point, literally in this case, we have to break below the November low. As long as the November low holds, we can move higher. I would say there's a serious warning below the December low. And of course, this week's low now needs to hold as well. But even if this week's low breaks, could be temporarily, could be a few days, it's not the end of the world just yet. But those are really critical levels to watch. So we should be in some sort of ending overlapping diagonal, which is quite classic. Things start to get a little chaotic. Just like with Trump and what's going on in Davos and in the world, a lot of things moving all at the same time. That's classic, I think, topping behavior. Things get a little bit chaotic. The market needs to digest a lot of stuff, right? Venezuela, China, Russia, Ukraine, Iran, Greenland. Wow, we're being thrown into the dishwasher, aren't we?
Right. I feel like somebody put us on a max cycle.
Right? Yeah. Turn up the heat. It's a lot to digest. Even for us on a personal basis, we're being bombarded with stuff. And the market too. And some might not be as relevant to the financial markets news as others. But, what's going on in Iran, for example, is, of course, tremendous importance, I think, for a global geopolitical positioning, oil, currencies, moving of tech hubs. There's a lot of potential going on there, but that has definitely not played out. That aside, so this is the pattern we're comparing. I've been tracking this with my members. and it's been a little bit back and forth. Is it following? Is it not? Because it will never exactly be the same. But so far, it looks okay. And if these futures keep on pushing, I think we're up about 1% on the tech sector, which is good. We can keep on pushing into that 71.20 zone, and that's been on my map the whole time. I'm still bullish, and again we have these turn dates coming up, and it would match. So if you look here at the length of this wave 5, right, and we're currently also in a green wave 5, this was about 5 months, and this should wrap up a little bit faster. Everything is going a little bit faster. The decline here for the wave 4 was a little bit faster, but again you see the same pattern here. So AB and then and a 4, AB, and a 4. It's not exactly the same, but it's quite a mirror image. They have a rally and a drop. We have a rally and a drop, and the previous drop was 50%, and the drop here in December also 50%. So it retraced 50% of this first rally. Then you get this ABC advance, another ABC advance, but this one is much faster. Here it took about 2 months, and here we're in about a month. So to get the market squeezed into this 2 turn dates, somewhere between April 18 and 28, give and take, we need to speed up a little bit. And that seems still to be the case. So we keep this as is. Now, I know there's a lot of alert waivers that have shown we might have topped. And yes, we can make a ending diagonal since the November low, 1, 2, 3, 4, 5. All right, it's loud and clear. We broke below it. But again, we have here these warning levels for the bulls, and this is the final one. I call it in red. So we broke below the blue one, 20% chance this large uptrend is over. We broke below the gray one, 40% chance. Even below the orange ones means 60%. But we're already back above it. Could have been a false breakdown. And the problem here with this ending diagonal, it hasn't followed any normal standard Fibonacci-based impulse pattern relationships. Normally, the third wave goes to about 100 to 123% of the length of the first wave. Well, this one wasn't even 100%. I think it was 0.76. Now, diagonals don't have to follow this pattern.
What does that tell you? Because it didn't quite reach where you thought it would.
It could be a total market exhaustion, but the internals do not favor that. Then you would say, right, the market is just so exhausted. Stocks are not following anymore. We'd see a massive divergence in market breadth, but I'll get back to that in a moment. There's none, and that's really interesting. In fact, the AD line just made new all-time highs last week. If that's the case, all we will see is a brief pullback, and the pullback can last for even 2, 3, 4 weeks, and then we'll move on to new all-time highs. It can never be a bear market, and I'll compare that to again, right? We're looking here for a large pullback, this black wave 4, akin to what we saw in 2022. Now that will require some negative divergence. So here I just plotted this. I posted for my members, the AD line versus the S&P 500. And in red here, you can even see that when the market moved higher, the AD line started to decline. And then we got the tariff trend tantrums in March and April. The same here in 2021. It foretold the 2022 bear market. We have negative divergence, meaning the market moves higher, but less and less stocks are participating, right? That's the classic signal you're looking for. That's that market exhaustion we're looking for. And we had a little one here in 2021, this scary period in the summer and fall of 2021. Market didn't move much. It just was digesting the recent gains. And then it moved higher again. Now, we don't have to have negative divergence. As you see here, 23 and 24, there are times when the market just drops. Those are most of the time fourth waves, and then it rallies again. So even if we would see a drop now that is going to last for a couple of weeks, I'll probably have to adjust my wave count and something else is going on. But we all know that it tells us that the market will quite quickly move higher. There's some exceptions. Again, nothing works all the time. I love the phrase from that movie, the Anchorman, right? 60% of the time, it works every time. When they present, I don't know if you've seen the movie, when they present.
Of course, who hasn't? Who hasn't?
Yeah, right, who hasn't? It's classic. So it's the same with the market. With everything you do, 60% of the time, it works every time. But this is a very reliable indicator. If I would plot this out all the way back to the 1920s, only big bear markets like the dot-com bubble, the housing crisis, the 1920s, 1930s crash, the 1970s market were all foretold by months to years of negative divergence in the AD line and price. That's what we're talking about. So the AD line measures simply how many stocks are advancing versus how many are declining. So if the AD line keeps on moving higher, more stocks are advancing. That means since it's the market of stocks, the stock market will oftentimes also rise. This is the AD line zoomed in since I would say June, July 2024. And again, we're still rising. So you see in blue here the S&P 500, the black you see the AD line, and we just made a new all-time high last week. There's no negative divergence whatsoever.
So when my takeaway here is, Arno, is that there's no way we're going to get a bear market from here.
No, not anything similar, not yet. I mean, could be price is the final arbiter, right? Price will tell us. So
price is always convincing.
Yes, I don't trade the AD line, but it can help us tell, hey, what is different between now and then? And if we go back here to 2024, which saw, or 2024-25, when we topped and we got this market crash here in March, April, which was really scary. That was a very big drop. We had big divergence going on. And the divergence lasted from November into February. And we currently have nothing. So this tells me, I'm not so convinced that this diagonal has ended, that this wave 3 has ended, because this wave 3 ends, we're going to look for somewhere around 5,800, which means 1,000-point drop. I mean, I know it sounds scary, but history tells us we need to be looking for some sort of months negative divergence between the AD line and price, and we don't have it at all. If anything, if today is going to end as a nice green day, and the futures seem to suggest it, we're probably going to make a new all-time high in the AD line. Again, all-time highs cannot negate a correction, but it also means the correction will be very short and will be bought higher every single time. But again, it won't negate a correction, of course not. But like here, if you see here, right, if we zoom in, this is between December and February. December 24, February 25, the AD line was going lower, price was going higher, and eventually the market was just exhausted. This is true market exhaustion, and it dropped. And from there, of course, it's completely replenished, completely sold out. And since then, the AD line and, of course, the S&P 500 have been in a steady uptrend with the usual dips that every time have been bought. So we don't see now versus then, not at all. I can't compare it. It's a completely, so this tells me that this setup of a very large third wave that will cause a 1,000-point drop is most likely not correct. And also just the price pattern itself is not correct. And I know a lot of analyticians have pointed this out, but then if you say, well, if we compare it to what we're seeing here, in 24 into 25, meaning that we'll probably start to see that divergence in the AD line a little bit later into the year, then it starts to make sense. But once again, we got to be very cautious and not put the horse or the wagon in front of the horse. The market is the final arbiter, and as long as we stay above these warning levels, and we just got a serious warning. I did give out a warning to my members on Tuesday saying, you know what, hey, the upside reward currently is about 300, maybe 500 points. So somewhere around there. The downside risk is 800 to 1,000 points. So from a little bit more of a longer term perspective, you just make sure that you know where we are within the bigger picture. From a shorter term perspective, there is of course always a lot more to be had, but the shorter term is always more variable, and that's what we're dealing with. But my point here is that, is this AD complete? Is this larger top in? Are we in a larger correction? Based on the price pattern of this AD line, I'd say no. Based on the underlying market breadth, also no. That's my take. But I'll completely change my mind if we drop below. I think it's November low, which is that 74 something. I'll completely change my mind.
And that's pretty far away.
It is pretty far away.
Yeah.
Well, that's even the December low at about 6,700, which is much closer. That already tells me 80% chance we're going to go lower. But if I look at this chart, we're above the cloud, we're above the 50. Yes, we're below the 10 and the 20. So short term, definitely downtrend. Long term, you see here the 200-day in red, definitely an uptrend. Intermediate term, as long as the 50 holds, also. So I think we're still in a bullish regime. So if we drop here below the December low, we'll also go below what's called the Ichimoku cloud. And that will then, I think, kick in a downtrend. As long as we stay above that cloud, which is like, as you're in the blue sky, so to say, we're good. And you can see here how in November, it just held that cloud, right? It held it perfectly. It started to get dicey, but it held it, and we're back above it. So if we drop below it, and you can even zoom out a bit. If we drop below it, like we did here in March and April of last year, right? You can see when we drop below it, no good. You get back above it, pretty good. We're still above it, so we're good. Kind of like, okay, let's go back to bed. But definitely Tuesday was scary, and the market has to hold certain levels. But I'm not yet in the camp of a larger top is in. I keep hammering it home to my members. I don't think so. We haven't broken below these levels. The internals don't suggest it yet either. So that's what I stick with. I don't kill the messenger. This is really objective facts that were just shared. But again, we can have corrections without any divergence. But most of the time, it's not, and definitely not a bear market. Bear markets, you need months and months of divergence before you get something akin to what we saw in the early 2000s, and that we don't have.
Okay, so we don't see a bear market. You see more of a corrective, like flat. I tuned in specifically to this show looking for the bear case. So I'm really unhappy right now, Arno. Just kidding. Just kidding.
I'm sorry. Yeah, bear markets are healthy, but they're scary. They cause a lot of problems for a lot lot of people.
They really do. But
I see. If anything,
that's a good optimistic view that you have.
Thank you. And I always also say, if you don't like the analysis or it's confusing, for example, we look here at the RSI 5 on a daily basis, and if it drops here pretty much below 5 in the 5 to 10 region, something like that, or what is it? Sorry, it's between 30 and 10. I was looking at something else. Between 30 and 10, it's a low risk buy zone, and that happened here. It happened here. It happened here. Every single time it happens, it's a low risk buy. Again, low risk doesn't equate to no risk. You can simply put as a trader, all the analysis aside and say, if it drops below that, I have to buy. That's my trading rule, and everything else be damned. And that's what happened on Tuesday. So you had to buy. And so far, if the futures hold into the rest of the day and going forward, it was a fantastic low risk buying opportunity. But a lot of people sometimes miss the fact that low risk doesn't mean no risk, right? There's always risk involved.
Yeah, absolutely.
Sometimes if you buy, it keeps on going lower. You can do a dollar cost averaging strategy, but honestly, this is a very good dip buying strategy, and you can put all the analysis aside. But honestly, from my perspective, I'm not so sure yet that the larger top is in. The internals don't support it, and the price actions in November would be okay, technically valid, but awkward as a top, very awkward. And I think there's some higher levels to be reached. Normally, the market does like to reach this important Fibonacci level, 7120, and we've fallen short by a couple of 100 points, and that's a little sloppy for the markets. So most of the time, we'll reach those levels closer than off by 200 points, maybe off by like 10, 20 points. That's more how accurate the market is.
All right. Well, that's a pretty good read then. So we're looking for a little bit more upside, and we're looking for more of a corrective flat. No bear market to be seen just yet. Or no, I want to say it's a really nice to catch up with you. I know I think I had to fill in one time, about a year ago, and have a chance to speak with you. Since Dale had unexpectedly resigned, I'll be putting together these interviews from here on out, and I'll be reaching out to you and have you here again.
Wonderful, Blake. Yeah, it's nice. I'm sorry to hear Blake left. Dale.
Yeah.
Dale left. Was always nice to talk with him too, but I love talking to you as well. And I always enjoy. I don't listen to your show daily, but when I am on and I hear you guys talk, I mean, what a high level of information this is. This is fantastic stuff. So I really, really am honored to be on a show with this level of information and these type of people like the previous speaker as well. I mean, that was a very deep, very good discussion. Great stuff.
Well, thank you. We appreciate it, and we appreciate having you here. So I'm going to be reaching back out to you and circle back and have you back on the show.
Awesome.
And if you guys don't follow Arnaud, you should. I've been following him now for a couple of years. He's at Intel _invest on Twitter. I've also we've retweeted you, so you should be able to find him pretty easily. Make sure you follow Arnaud. So thank you.
Awesome. Thank you. Thank you so much, Blake. Really appreciate it.
All right. Well, hey guys and gals, I want to thank you all for being here today. It's been a busy one, and believe me, volatility is going to be running amok for the next couple of days. Tomorrow we will be back on the F.A.C.E show. Actually, Ryan and K-Man and Stelios will be here as I have other commitments, but I'll be back at the second half of the show just to follow up with you guys. So make sure you're back here tomorrow, same time, same bat channel. You guys have a great day. Thank you so much for being here, and good luck today. May all the pips come your way, and I'll see those of you that are in the Forex Analytics community. I'm going to see you on the Morning Edge.